participants. So we have participants logging in. We'll just wait for a couple of seconds more and then I'll start. Someone is logged in. Just check. At the speaker. Okay, so good evening and welcome everyone to Almus' 6th webisode. This is the monthly webinar series that Almus started 6 months back. It's a monthly series, and one of the objectives is to spread the knowledge. At Almus, we are the information and knowledge aggregator, and our endeavor has always been to share the same with our clients, with our prospects. And this format is one such initiative that we have taken to ensure that every one of you are fully empowered with the knowledge and the updates that's happening in the financial market. With that, let me welcome all of you who have joined in. I really appreciate and thanks so much for your interest and enthusiasm. Your participation definitely encourages us to come back with every monthly webinar series. And thank you all very much for your interest. With me, I have two very renowned experts. I say renowned because one is a known name in the financial market, and the other one is a known name amongst our client and in the financial market community. And I'm referring to Saugata Bhattacharya, who is a chief economist at Axis Bank. He's an executive vice president at Axis. And prior to Axis Bank, he earlier worked with Infrastructure Development Finance Company, IDFC, and Hindustan Unilever. But I think more importantly, the kind of position that he has held in various associations, and some of them are CII, SOCHM, FICCI. He has been a very active participant in the RBI and Ministry of Finance. He has been a key man who has been a member of committee which was related to the development of the India's capital market. I think his presence here will mean a lot, not just for Almus, for all of you. He's been named a Chevening Fellow of the UK government in 2017 as an alumnus of King's College London. So thank you very much, Saugata, to really come here and spend your valuable time with us and with the participants. And Mathew John, most of you connected with Almus definitely knows Mathew. He has been with Almus since inception, MBA, BTech, and MS by qualification. He heads the in-house technical research team. Someone who's been definitely sought after by many corporates, not just for managing the currency risk, but even the commodity and the bond market, the bond portfolio. He has been instrumental in Almus strategy, especially when it comes to currency market and the commodity market. He's been with Almus for I think since inception, when I said 2012, so almost 11 years now, and his learning passion never ends. Just to add the last bit, very recently he has acquired learning from EDHEC Paris. I find it even difficult to pronounce. And he has been also an expert in the New York Institute of Finance as an algo trader. So, these are all some of his credentials. These are all the two experts who are going to talk on today's topic, which is a slowdown in the Chinese economy and its impact on the global and the India economy. But as the format goes, let me first take you through the ABCD of the topic. Some of you who have attended this webisode regularly, they know first few minutes. I cover the topic in a very layman language. What exactly the recession and the slowdown that we are talking about. I will cover that up. and post which I will then have an expert view on the recent, or I wouldn't even call it recent because it's been now more than a year that the global economy is facing the Chinese slowdown. It's a very, very critical and important element of the global growth, and what its impact could be. We will have then the speakers covering it up. Now, I will just start with ABCD of recession. Brief introduction about me. I am one of the co-founder and CEO of Almus Risk Consulting. And at Almus, we are specialized in managing currency, commodity, and interest rate risk for the clients. And Almus, I'm proud to say that we are the pioneer in FX outsourcing. So with that as a background, I will start with my presentation on ABCD of recession. I hope you're able to see this. Just one person say yes. Kushi,
yes,
are you
yes.
able to? Yes. Okay.
Yes.
So what is recession? And before I come to recession, let's talk about few critical elements that helps us identify what the recession is. So here I've just put certain few elements: gross domestic product, income, employment, trade. And let's understand when we say recession means what. The arrow down that you see signifies that when in an economy, the overall level of income, overall level of employment, and the momentum or the quantum of trade reduces, the economy is slowing. It's like the pace at which the overall elements are in the economy are growing. And the reduction in all of that indicates that there is a general slowdown, both in the income and employment, and as a result in the overall trade basket. Now, in the technical terms, especially amongst the global accepted definition of a recession, is that there are 2 quarters of consecutive growth or degrowth would mean that there is a recession. So which means that in the chart that you see in front of you, Q2 and Q3, the red line, which is a down growth. When any economy reports on a quarterly basis a down growth or a degrowth, it qualifies as a recession. Very recently, we have seen Germany reporting the 2 consecutive quarters of degrowth, and that qualifies for the definition of a recession. Now, when we say gross domestic product, what exactly is this? Nothing but as we have an individual, a value of net worth, a value of a person denominated by of your individual net worth, you have a combined activity. And this is again a very layman. So we have an economist, so please pardon me if I'm technically not correct in defining the whole terms. But having said this, this is basically the total activity in a country is what would qualify as a gross domestic. And when you see a slowdown in all of that, by way of what? A reduction in the consumer demand. As a result, you will have a reduction in naturally an investment, the level of investment. And that in turn can lead to a kind of a situation in the country where it could be even a financial stress. So what generally happens during the recession? You will always find, because a government would want to fight the recession by way of a lower rates, lower sales of the business. You will have a lower interest rates in the economy, maybe an impact on the by way of a higher unemployment, and all of that will lead to a lower, it's a cascading effect, a downward spiral as we call it. So these are all the impact. Now, this definition is relevant because in the context of today's topic, the thing that we are going to understand in the next few minutes is the Chinese economy. And all of us know that this economy, the China engine, has really, really slowed down. Now, there are a lot of, I would say the data from Chinese economy is always a challenge, the authenticity of the data. And that is where we really need an expert's insight into understanding what the economy is, A, where it has come from, and B, the pip into the future as to what can we expect really in the time to come. So let me first invite Saugata ji. Sir, over to you. I have your presentations and I can flash that for you, and you can start. Just give me a...
That'd be lovely.
Sure.
So thank you, Maulik Saab. Thank you, Jairam Saab. I mean, a huge privilege as always. You know, I have been associated with Almus for a long, long time. I've participated in many of your programs. So it's always a pleasure to be here. Thank you again for this
Pleasure is
opportunity.
ours, sir. Thank you so much for really, being so kind enough.
So I'll as we discussed, I'll talk for about 20 odd minutes.
Sure.
And then let's have a interactive session with
Absolutely.
you, with your guests. That makes it more interesting.
Yes.
Then we'll be able to answer specific questions. So this thing now, in terms of what in China, I mean, President Xi is very keen on this term, strategic patience. So it will be, as you will see, a fairly long drawn process of Chinese recovery. But let's get to the first part. I want to start exactly as you started with the definition, the ABCD. I just want to lay out some basic numbers because then you will understand how vital China is to the economy. This is in 2022. The US is definitely the largest economy in the world with $25 trillion GDP. This is in nominal terms. China is the second, about $18 trillion. India is number 5 with $3.5 trillion. As you will see, our basic problem in India relative to the rest of the world is our low per capita incomes because of the large population that we have. I mean, obviously. So the US is way ahead at $75,000. China is quite, I mean, compared to India, our per capita income is about 2.5. If you look at it in purchasing parity terms, so the cost of a burger, as it's called, we are much higher. We will be about $11,000 to $12,000. China will be about $18,000. But in real dollar terms, we are still lagging. We need to catch up. The last bit that I want to point out that we'll be talking about China's extraordinary growth story, etc. If you see the last 10 years in terms of the CAGR, the CAGR, compound annual growth rate, India has actually done fairly well. China's CAGR of the last 10 years has been about 6.2%. We hear China's 9%, 10% growth. That was a 1990s, 2000 phenomenon. But the last 10 years, India's CAGR growth of 5.5% compares very favorably with China's 6.2%. So this is just the layout in terms of what we'll be talking about in the next slide, please. So there is absolutely no doubt, as you mentioned, Maulik Saab, too, that China's economy has slowed. This is the IMF's prediction forecast that was released in end July. So it's already quite outdated now as of this point in time. China's target growth is about 5% this year. And the first couple of quarters have been quite good. So about a 4.6 and a 6.2% growth for Q1 and Q2. Remember that these growth numbers don't really reflect reality because the last year growth, the zero COVID policies, everything was shut, etc. So this actually is a fairly low number. Last year, China did a 3% growth, which is unprecedented. This kind of divergence from their 5% growth target has not been seen ever, or at least for the last 30 years. This year, they will probably try their level best to hit a 5%, although now my colleagues in the global banks, etc., their forecasts are now anywhere between 4.7 to 5.2% for China's 2023 growth. And next year, it's going to slow down again to 4.5%. So let's get into this. In terms, and this will have an impact on the system. There is no doubt about it. So I'll come back to this later. So the current slowdown in China is, as everyone, I mean, all of you, I'm sure, have read about this. One of the key drivers and key reasons for this current slowdown is the real estate segment. And real estate segment, remember, is a very large part. One of the key things, so from China's economy, the GDP will be, say, about 5% growth, which they have to achieve because otherwise the optics will not be very good. Households and business have become very wary of spending. We'll come back to this later. So property sales is now, compared to vis-a-vis 2019, property sales are down almost 50 to 60% of what it used to be in 2019. That's a very sharp fall. And as you can see with the charts, property investments, property sales by floor area, funds raised by developers, all are down. Things are a little better in the second quarter, but it's still deeply negative in all. So property sales in April was down 50 to 60% of what it was in 2019. Existing home sales prices were down by about 9% in July. New construction was down 40% relative to 2019, which is the pre-COVID year. The problem is that Chinese households tend to invest a lot more in real estate, in flats, apartments, housing, etc., than they tend to do in stock markets. And this, obviously, this kind of slowdown in the real estate segment will have significant wealth effects. Yeah. In terms of the effects on capital markets, this also has had a major problem. Of the 50 large property developers who had issued overseas bonds, 50 large property developers in China who had issued overseas bonds, 34 have already gone in for restructuring. You've heard of Evergrande, you've heard of Country Garden, the two largest property developers. They are effectively bankrupt. Although I just read in the news today that Country Garden has managed a deal with local financiers, domestic financiers, Chinese financiers, to push to restructure about $1.5 billion over the next 18 months. So that gives them a little bit of a breathing space, but overall they're in a bad shape. So that is something. That's the basic structure of this slowdown. There are other things as well. Obviously, as we said, given the kind of investments that lie in the real estate segment, many households are very wary of this. Remember that in China, this is the way that bad demographics play out of the system. Chinese pension assets, by way of percentage of GDP, is lower than India's. So the amount of money that Chinese have in their overall old age spending. And given the bad demographics, every working Chinese has to support 2 parents and 4 grandparents. So that's the kind of inverted structure which is creating this hesitancy in spending in China. So keep that in mind. The question that we now come to is what could have led to this level of slowdown? What is the cause for this slowdown? One of China's key growth characteristics is an extreme imbalance in terms of the composition of the GDP. Remember, Maulik Saab, you showed the GDP structures, household, investments, exports, etc. All of these comprise economic activity, which is essentially GDP. In China, investment is about 44% now. In 2022, was 44% of GDP. 2 years back, it was 47%. For developed countries, advanced economies, it's typically in the range of 20 to 25%. For fast-growing emerging economies like India, it's typically in the range of 30 to 33%. China's investment to GDP ratio is 44%. So that gives you an idea of how much this imbalance has crept into the economy. Real estate is 30% of GDP. Yeah, that's a very big number. Just to give you an idea of the scale, in India, about 350 to 400,000 apartments, flats, are sold per annum every year. In China, 10 million. India was 350 to 400 flats, apartments, that is on average sold in a year. China is 10 million. China's built up, the average constructed area is about, per person, is about 550 square foot per person, the average constructed area. The US, which you saw in terms of per capita income, is so much higher, $70,000 versus China's $13,000. The US is about 700 square feet constructed area. India is 100 square feet. So that's the kind of investment that had gone into the real estate in China. Obviously, we are seeing the consequences now. This pain is largely, unfortunately, self-inflicted. Yeah. So concerns about inflated real estate prices. This arose 5 to 6 years prior to that. But real crackdown started about 2 years back. And President Xi's famous saying that property is meant for living, not for speculation. All of you have heard about President Xi's the Common Prosperity Program. And real estate is a very key component of the common prosperity. So they were trying to get the prices down to make it more affordable. Affordability of housing was a very key component of the common prosperity program. Yeah. To compound all of this, in China, local government bodies, as they're called, LGBs, which is the town, county type of government, not the center, not the states, the local government bodies. These are very heavily invested in real estate. So obviously, with the real estate now coming down, and given the kind of the debt levels that you see, 300% of GDP, the total debt in China, which is number 3 after France and Japan. I didn't know that France was so heavily indebted, but France, Japan, and number 3 is China, 300%. That automatically constricts the degrees of freedom that you can use, the policy levers that you can use to reflate the economy. And then on top of that, to create even worse problems, then there was this massive crackdown on entrepreneurship. And this is also the part of the Common Prosperity Program, because the Chinese Communist Party felt that, number one, they were losing political control to the entrepreneurs. And second, this increasing disparity of wealth. I mean, the entrepreneurs, startups, tech companies were pulling in massive amounts of income, wealth, etc., to the detriment of the masses. And now, third, on top of everything else, and this had to come in just at the right time. You remember that chart from the IMF, that there was a significant slowdown in the exports of goods and services. China is one of the major exporters of goods in the economy. So from about a 10.7% total imports trade in 2021, it had come down to 5.2%, and this year it's forecast to be 2% of the system. And even worse, to the advanced economies, from 6.1% last year to 2.3%. So that's the third impact that is coming. So now the key question is, so are we likely to see a crisis emerge in the system? Till now, we have not seen signs of this crisis. So not many signs at all. So despite this very weak real estate segment, we have not really seen any signs of any major stress in the, particularly, forget about the banking sector, the shadow banks, which are a large part of the total financing that happens in China. We have not heard of any, I mean, as you were saying, Maulik Saab, we don't really know the quality of the data, how much is revealed and how much is not, but we have not really seen any major signs of a problem in the shadow banking system. On top of which, the total amount of sovereign bond deals, which is sovereign bonds, remember, is always a good sign of any prospective problems coming into the country. Sovereign bonds in China have actually outperformed US government bonds, which is not because Chinese interest rates have been very low and the US interest rates have shot through. But be that as it may, over the last 3 or 4 years, Chinese government bonds have actually outperformed. So, I mean, in terms of an immediate, imminent crisis, we don't really see that much of a problem. But there is a problem going out into the future. What policy options now does the Chinese government have to reflate the system? You saw the picture on debt, as we said, 300% of GDP. On top of which, the next slide, which is this is an even worrying slide. So whenever in the past, during the global financial crisis, etc., China had a problem with growth or financial stability, etc., they just spend their way out of the problem. But that in the initial years worked, not when you have this level of investment built up into the system. That just doesn't, spending more on investments on roads, buildings, ports, railways, etc., just doesn't have an effect on China. So this effectiveness is going down. As you can see from the chart, at some point in time in 96 or even very close in 2004, you needed to spend 1 unit of capital to get 1 unit of output. Now you need to spend 5 units or even more of capital to get 1 unit of output. So that increasing ineffectiveness of the additional investment is beginning to weigh down, is likely to weigh down on investment. So that's not the way to go. Yeah. So efficiency of investments being very low, investments is not likely to happen. So there have been small, mild interventions. I mean, all of you have read through this. I mean, there are some small incentives for buying electric vehicles. I mean, the Chinese PBOC, People's Bank of China, the central bank has cut rates, various kinds of rates, lending rates, deposit rates, etc., but relatively small amounts, 15, 20 basis points, not too much. Yeah, there are other restrictions on housing. There were massive restrictions on investing in a second home. So there have been some easing of those restrictions. So on the margins, they have tried to do things which to improve ownership of a second home, easing restrictions on holding on homes in tier 2 cities, etc. So some little bits, but this is nowhere close. This is not adequate to do the kind of the reflating the economy. Exports this time are not likely to help, which is another reason that you have not seen a very major depreciation of the currency. It has depreciated, but not a major depreciation of the currency, because the Chinese economy is now too large for exports to have too much of an impact. So it has to be a local domestic solution. The only way now out for the Chinese is to rebalance. Remember, we were talking about the extreme imbalances, the high share of investment, low share of household consumption. Now it has to rebalance. Expenditures have to rebalance from investments back towards household consumption. And that's the only way that you can stimulate consumption in the economy. You have to shift. And remember, we talked about the local government bodies, LGBs, having large investments, particularly in the real estate sector, but across, in multiple ways. So this rebalancing now has to happen from the LGBs back into the household sector. And obviously, this kind of rebalancing with a loss of value of property will lead to severe wealth destruction. So somebody has to take the losses. Somebody has to bear the losses of this wealth destruction. Remember, the thing that we had, a similar kind of thing happened in Brazil. There were very big, very bad investments in Brazil in the 1970s. And they had to spend the entire 80s trying to rebalance out of this. So to get back out of those bad investments, to restructure, go past that wealth destruction took the entire 80s. So typically now there are multiple ways in which can rebalance. Who will bear the wealth loss is the key question. Households, typically, if they have to bear this loss, typically leads to consequences on banking. The banking sector, bank runs, etc., begin to happen. So bank capital is lost. So that probably, they will be a little wary of this. Foreigners, they're too small to bear the losses. They're not big enough in China. Business, that's one impact, but that will lead to a further slowdown in growth. So that also probably is a little not desirable at this point in time. So the only guys who remain is the government, both the center as well as the LGBs, the local government bodies. So then obviously the center, Beijing, has to now look at how to force these adjustments, the rebalancing adjustments on the LGs. Problem is, the LGs, the local elites who are the bosses in the local governments, they have very large power, and they will not relinquish power to this balancing adjustments, etc. They will not do it easily, which is the key political problem. This is the key political issue, and this actually shows. I didn't know of this. This actually shows why President Xi, has been so keen on consolidating power in himself to try to reduce the political influence of the local government bodies, because they will have to bear the losses. So I talked about Brazil. Brazil is relatively small compared to these kinds of imbalances and the adjustments that needs to happen. So there have been two instances in history with involving this kind of rebalancing. The first one was 1930s, the Great Depression in the US. The second was the rebalancing, the adjustments in 1980s Japan. The US, and these offered different models. So the US was a very sharp, a very significant, concentrated rebalancing exercise, very major pain. They lost 30% of the GDP, but the pain was relatively short-lived. In the 1930s, it got out and started. The war happened there, and the Second World War and things. The pain was short-lived, but it was intense and excruciating. 30% of GDP lost, gone. The second model, and this has, I'm not very sure that this kind of thing, particularly in a society with as deep divisions, etc., as China, will be a feasible thing to do. So the second model is Japan rebalancing in the 1990s. Much more gradual, but happened over a long period of time. No bank runs, no nothing. But as you know, they still haven't fully recovered. So it's going to be a long process And remember that Japan in the 1980s was much richer than China is now. And the levels of imbalances that Japan had is nowhere close to the imbalances in China. So it will be a long path for China to go to hit whatever. I mean, this is the reason now that you're beginning to hear of a so-called balance sheet recession, which is even worse, which is the one which will dig China into a hole. Yeah. So in other words, I mean, debt deleveraging, the demographics, etc., weak demand, that will keep growth. So all of this gone. So there is no doubt in my mind that China will go into the second paradigm, the Japan paradigm. It might lead to a balance sheet recession, it might not. But what they would probably try to do is to transfer 1 to 1.5% of the local government body wealth and incomes towards the household. So, I mean, I didn't know of this, that the local government bodies owns an enormous range of real estate properties, from restaurants, convention centers, hotels, buildings, etc. So the idea is to build, to sell some of these assets, probably to the private sector, use the cash to build affordable housing in empty lands or whatever, to buy land, build affordable housing, and use that to resettle many households, etc., in some of these affordable housing buildings, etc. But it's going to be a long process. It's not going to be a fast process, 1.5% of GDP every year. And given the fact that households own less than 30% and these guys own 40%, so we are talking about the next decade and a half to do this kind of thing. So the second thing that is likely to happen with this kind of rebalancing in China, it's going to be a very regionally differentiated process. The entire coastlines, I mean, all the Shenzhens, the Pudongs, the Shanghais, the Guangzhou, etc., they will be doing very well. Their economies are diversified. I mean, they have lots of growth drivers, etc. So they will not be particularly affected, although they will be, obviously, I mean, with exports and building construction, but they will not be as affected as the 2/3 of the rest of the China, which does not have this kind of diversified economies. And that's the worry, because that might lead to political problems going ahead into this rebalancing exercise. Effects on the world, which is, I mean, obviously, I mean, China has been a major absorber of demand, and that leads to commodities. So commodities, as you will have heard, I mean, it's been relatively stable. Metals prices, despite a little bit of the abatement of recession fears in the US and Europe, etc., metals prices have remained very, very stable, except for copper, because of the carbon decarbonization and renewables energy mobility things, which has kept copper up relatively. But other than that, all the metals prices have not impacted. So that is good for India, because we as a large commodities importing country will benefit from that. The worry is now in terms of currencies. And China's currency has depreciated relatively fast. From about a month and a half back, it used to be about 722, 723 CNY, as it's called, the Chinese onshore currency, which is the green line that you see in this. Remember, last year, you have to note this, that last year, there was this shambles because of the strength of the dollar. Till about October, November 22, the dollar index had strengthened all the way past to 114, 115, the black line that you see, the way that the other DM currencies, developed market currencies, had depreciated against the dollar, and that had taken that entire slew of emerging markets currency, the green line, which is the CNY, RMB, the red line, which is the INR, which is the rupee. But post that, the CNY had actually appreciated significantly. And given from there, that levels of appreciation, it has depreciated significantly, but not that significantly relative to the slowdown. And remember that all the other central banks had been raising rates during this period. The PBOC has held rates stable and then started cutting rates. So the currency should have depreciated much more. I mean, they have used different techniques, but again, I mean, the currency is one. So the currency at this point in time, if China slows down even further, and the PBOC is forced to ease monetary policy in various forms, whatever, the entire emerging markets complex will face significant volatility coming in from the CNY. That's something with Maulik Saab, Jairam Saab, that's your core in terms of currency volatility. We should be seeing currency volatility because now, even now, a significant amount of the extreme uncertainty that characterized the developed markets monetary policy is now getting shifted to China. And the CNY will bear the brunt of this level of currency. So in other terms, in the short term, we will probably be a beneficiary, net beneficiary from this. But over the long term, if China indeed, I think basically the takeaway from all of this is that the days of the extraordinary 10% growth is now gone, is over. So China will now revert back to a normal type of economy. Many commentators, analysts are predicting about a 3% stable growth from China. That will probably, and given the fact that China has been a large sink of global demand, with their huge the current account surpluses, etc. And this is exactly the way that Japan has progressed. The huge current account surplus that Japan had built up in the 1980s, has slowly depreciated and slowly reduced over a period of time as it has rebalanced its economy, and that's exactly the way that China will probably be going. That, to my mind, is a long-term demand shock for the world. And if the world slows down, world trade slows down, world investment slows down, that will inevitably have an impact over the medium term or the long term on India's growth. So over the long term, we need to wait and watch what kind of domestic growth drivers we come into the system. But there is a demand shock in the offing coming in from China. So that's pretty much all I had to say. Thank you very much for this opportunity.
Great, Saugata-ji. I think you have covered the entire spectrum. In fact, I was looking out for questions in one or two areas where I thought you were not covered, but I think overall you covered the whole of it. Let me try and sum it up. You talked about the investment boom in China, infrastructural related. Then you talked about the severe debt burden because of the investments, impact on the local economy, trying to rebalance from an investment to a consumption led. While it does what it does, there is definitely an impact on the global economy and India in particular. Now, just one or two questions. I think you have covered most of it, but slightly further going into the two specific points that I want to put it across to you. One is China did what most of the economies in the past probably 100 years would have done. There were decades of investment or infrastructure-led growth. So you had a 10, 20 years. We have seen it in US, maybe early 1930s. We have seen it in UK post-World War I, II. So economies have spent money on infrastructure building, and that has really led to a boom in the capital spend, which is what China did. It created opportunities for certain parts of the world economy. Then, my question is, what impact will it have on those segments of the market versus now today, while China is rebalancing it from an investment to a consumption, where they are really sort of, enriching the households, which in turn would lead to a consumption boom. There could be emerging trends for certain segments of the economy or the global economy, which could be really benefited. So what the risk to the class of those people which really benefited earlier, and what could be the opportunity? If you can just highlight those two risk and opportunity area to sum it up your overall analysis.
So again, I mean, I think that's an excellent summary. I don't need to, you've said this so well yourself. So one thing that you all of us notice is that China is trying to move up the value chain into the key technology-rich areas. They perceive that as the next driver of growth, be it materials, be it genomics, quantum computing, artificial intelligence. I mean, they're leading the world now. All of you would have heard of this new thing on the Huawei Mate 60 Pro. The kind of chip that they have managed, and not just the chip, their entire ecosystem of that handset. So the US has started a probe now, and how did they manage to get that technology? So that shows their level of expertise. They're trying semiconductors, etc., down to a 3 nanometer level. So they're determined to make sure that their technology edge that they already have, that keeps on, that's maintained throughout the thing. But that's a small part of the economy. that will not entail the kind of investments that you saw in, I mean, the roads, sports, the trains, the housing, real estate, etc. So all of that, that's a very small part of investment, although that's not insignificant. $50 billion that they intend to spend on semiconductors, hundreds of billions on space, etc. But that pales in terms of what they have spent earlier in infrastructure. The key question now is, again, how this rebalancing works. Can they manage that rebalancing to from 1.5 to 2.5, 3% every year? And that will increase the spending power, the purchasing power of other. The other point is in the kind of economies of scale that they have built up. Yeah, the huge factories. I mean, there's no country. I mean, it's no country in the world can match the costs per unit of China, in whether it be solar, whether it be electric vehicles. I mean, the kind of lead that they have in that entire energy transition industry. Batteries, storage, electric vehicles, BYD, etc. So everything. So that will probably, I mean, and now you've seen that the US also has realized this is the thing that the US is trying to build up, mend some fences. So initially they had started with this high wall, big yard. I mean, high tariff barriers across a whole range of industries, etc., which they have realized is not going to happen. Yeah, that is shooting ourselves in our own foot. So now they have shifted from the big yard into a small yard, high fences. So that those supply chains will keep on happening. I mean, otherwise the costs of doing business in the world will be so large that it's going to be self-defeating. So those things are going to happen, but the high technology areas are the key parts of the game. But other than that, in terms of the rebalancing exercise, the local political claims are becoming very, very important now. I don't know whether you've heard of this recent story that was published by Nikkei in terms of one of the key deputies of the old the Chinese president Jiang Zemin. Yeah, Zheng Dongdao, who they have this summer conclave, the Baihadzei conclave, summer conclave, and President Xi was apparently taken to task. Yeah, so because I mean, apparently from what the Nikkei story says, that people have started questioning that what exactly are your achievements in the last 10 years. You've made enemies of all your neighbors. You've ratcheted down entrepreneurship. You've gone after corporates. You've spoiled by foreign relations with your neighbors. Your growth slowed down, etc. So what have you achieved? So these questions are now beginning to be asked. Yeah. And how this reflects the dynamic between the center and the local government bodies will be very key to the pace of this rebalancing that is going to go.
Very interesting. I will invite Matthew to come in and share his insight. In the meantime, just one question which has come up. I think that's from Jairam Krishnamurthy and Saugata to you. Does this push back China's ambition to become the world's reserve currency? Matthew, just a minute. Let him finish and then I'll come to you. Yes, Saugata.
So, I mean, it will not. I mean, China's the RMB is already moving towards a reserve currency. So RMB is part of the IMF's SDR basket, as you now know. 6 or 7 currencies in the IMF's SDR basket. And definitely after the lessons of the US sanctions post the Ukraine invasion, many countries are now very keen to diversify out of the dollar into other currencies, particularly their own currencies. The thing to note is that China is a 800-pound gorilla in trade. I mean, despite that, the BIS conducts these triennial surveys. Every 3 years, it conducts a surveys on the use of currencies and reserve currencies, trade currencies, transactions, etc. From 2019 to 2022, which is the last survey, China's share rose in terms of global trade, global transactions, everything, capital, trade, other transactions. China's share rose from 1.5 to 2.75. And of this 2.75, 1.7 was trade between Hong Kong and China. So China's, despite the heft that it has, The BRI, the Belt and Road initiatives, the kind of capex spending that China has done, huge share of global trade, etc. It has not really managed to increase the currency. It will now move. I mean, it will now accelerate. I mean, all the transactions between the GCC countries in China, in terms of China's oil trade with Russia, with other trades now that China is trying with Africa countries, things will increase. But as a global reserve currency, I'm not very sure that it's going to get too much traction. It will increase from the 2.5%, 2.75%. It might goes to 4 or whatever. But the entire ecosystem. Remember that the 80%, 85% of global transactions in cross-border transactions is capital flows. Yeah, it's capital. And as New York or London or Singapore as global financial centers, they cannot be replaced here.
Yeah. Thank you so much, Saugata for your insights. Really appreciate. Let's hear from Mathew. Mathew, and as I interact with Mathew, Mathew has a presentation and we'll put up a few questions.
Yeah.
Everyone, if at all you have any questions, we are not keeping any separate session for a Q&A. Feel free to put it up in the chat box. I'll pick it up. Mathew.
Maulik, I need to share my screen. No? I have the rights.
Just try. Yes, you can. You can.
Yeah. Full screen. So I'm sharing.
Please.
And mostly, I think what I will end is I will summarize what you both have said. Okay, I have a slideshow. Are you able to see the screens now?
Yes, Mathew, we can.
Okay. Just prompt the questions in between. Few of them are obviously few of the slides will overlap. So basically, what happens is the narrative post-COVID was like USA, India, and all came back after COVID. So there was a huge demand spurt. So this was so Chinese coming out of lockdown was supposed to be the world's largest stimulus. So commodities and all were starting to rally. There were a lot of talk about great, demand pickup, supply side constraints, pushing up inflation and all that. But suddenly, what we have found is that these are ideally what you both have now talked, that it had come to 5 disappointments. So one is that we have seen that the demand side is there is nothing. There is no extra demand that has come down. Of course, commodities are rallied and all that. We'll see that. And one more most important thing is I will try from putting this in 1 or 2 slides and come to the market perspective side, where try to forecast what can happen from the market point, where FX and commodities space can go. So from the demand side, and these are the 5 disappointments. Demand, from the debt side, we are seeing that local governments taking more debts and putting in fixed asset investments and all that, which have all kind of backfired. And demographics, where the fertility rate is going down and the age of people are increasing, like it is going to fall. So all that is basic. But then there are 2 important developments. One is that there is some kind of a decoupling in trade also. And for example, now I think yesterday the news came that Mexico has become America's largest trading partner. So Mexico is able to, directly substitute Chinese. So the whole and important thing is that what we saw in G20 was a kind of an isolation of China. Even Russia couldn't do much. So we saw that during the G20, whatever antics China was on to with G not coming and all, we saw that Italy announcing that they are going out of the Belt and Road Initiative and all that. You saw that Biden specifically going to Vietnam, talking there, taking a press conference and announcing that China may not try Taiwan because their economy is weak and all. These are all signals that there is a diplomatic isolation of China. How it will pan out, we don't know from international affairs. But point is, with the demand, debt, and demographics that you both know, there is decoupling and diplomacy. That are the 5 Ds of disappointment in the Chinese slowdown shift. So the narrative has shifted. So this will affect investment. It may affect. See, last time we had people, the leaders trying to make the country liberalize in a way. But now Xi has to do some other kind of stuff where he has to hold the Chinese population together, control all the dissent, and then try to get per capita income and all at maintain that level of it. So this is my first slide, which is showing the demand side of it. I have no time, so I won't need to explain it. It's just that post-COVID disposable income, per capita household consumption, all have come down. So this is demand side. The long COVID, instead of spiking up demand, it has gone to the opposite side. So very fascinating stuff. There may be a reason for this. And this is the property investment and the fixed asset investment. This is what Saugata was saying about the local government financing vehicles. They used to lend enormously, a lot of corruption. They used to lend, and somehow these developers, they took out money, and it is like a black hole. And the cost of capital was subsidized by government spending. Now Xi has stopped it. So suddenly these companies, these special purpose local government vehicles are making a loss. Now this is now reported by the local governments. Now the Communist Party is under pressure. So all these things stuff are going in the background. So this is from the fixed asset investment point of view. Now, this is what is the demographics showing fertility and aging. Fertility rates are also coming down. The latest report says that the fertility is gone below 1.4. So below replacement is kind of Japanification of China. So if Japanification of China happens, what will happen to global demand and all that Saugata was alluding to the end of his presentation. Now, this is the most important thing, the Chinese-US strategic competition. It's like we might have, most of us would have watched Oppenheimer movie, where the atom bomb was kind of defined what the Cold War was. Now AI is going to define what the next century will be. So anybody who is is not in AI is out. Whether it's business, whether it's so in the whole background is one is that one is the climate change kind of thing. Either you have to be there with the AI thing. All companies, all nations have to be in the forefront. India is making enormous strides. Indian companies are, with government support, trying to link with a lot of companies like, American companies, SMEs, what is that? I forget, AMDs of the world. So this is done because there is a strategic competition, a strategic shift that is happening. So this G20 also was shown that change is kind of visible. The signaling is to the Chinese. And for us, from the market point of view, is that people know about this, but people have not priced it. The market has not priced it. How it will pan out is not being priced. So these are algorithms that BlackRock uses, which take big data, whether it is what we speak, whether it is in Twitter, whether it is whatever in sentiments or in words, and they analyze it as a metrics. So this is a global techno Cold War. It is fought between USA and its allies, where India is now a non-aligned, a multipolar one, but between America and China, but other nations are vying for that space. So there is friend shoring and all that happening, which India is a friend to all these countries. So we get the benefit. But this is what is happening. This is the biggest change, that dynamics of change or regime shift in the global economy and geopolitical space that has happened. Maulik, do come in, okay? Because in case you want to. So this is what exactly happened is now coming to the exchange rate. Now, because of Chinese stock market not performing well, or they didn't have their interest rate being in the lower side, people didn't have many places to go, to park their funds. So this is what has happened is that there is a lot of parking of funds in the banks, and some of these funds would have found some way, whether it is a Hong Kong Connect, I don't know, it's a Hong Kong Connect, or what they call is as DQs and FIQs and all that, which is like portfolio investments. There's a lot of channels where they can take out money and invest in other assets in abroad. So there has been a lot of money flow that is going. This is from Adam Person's Foreign Affairs article. This is the start of the pandemic. This has gone up, which is that a lot of deposits have been coming into the banking system, but some of it has leaked to it. And this is putting pressure on the exchange rate. So this is the first trigger that the exchange rate started, and people started then noticing all these narratives and all these disappointments. Now, just like we discussed, China is not collapsing, because some of the Western narratives is that China is collapsing. But there is just some rebalancing that has happened. Because if it is collapsing, then we are not below the metal prices, because most of these industrial metals, China consumes almost 70% of it, 40% of it, copper, 30% of it, palladium, platinum. All of them are getting consumed by China or these vast industries. So that is not breaking down. So the big importer like China, if that was the case, cotton prices went lower to 40, 58. It then went higher to 150, then came down to 72, and now up around coming to around 88, 90. So industrial textiles, other commodities are not breaking down. So that means that there is some kind of a slow process, a slow kind of rebalancing or a kind of a turnaround. That is possible, but we don't know. But what will support the rebalancing? That would mostly be the exchange rate. This is what the CNY exchange rate has to bear the brunt of it. So that means that the exchange rate, our initial target, I mean, last year was around 7.3035. Now we'll have to shift it. So this is new to all of you also, our team also, that we have to shift it towards 7.55, 7.60. So what does happen to the Indian currency? So now another important thing is that this is the export slump that has happened with each country that China has, as China has a trading partner. So this is pretty large. So the exchange rate has to adjust. So this is one more evidence that we can bet that the exchange rate need to be weaker than the present rates. Now, another thing is what US, if US rates are going to be higher for longer, the Fed is going to at least maybe pause, but rates will be high, and China is going to cut because of all these reasons, or maybe their economy gets weak. Then you have the currency again to move up, and dollar index has held the 199.50 support, and it is now bouncing up, which we've seen against euros and other currencies. So with that support holding, if that support breaks, then China will have relief on the exchange front. But otherwise, it becomes very difficult for the currency to get even a minor relief. So it is really pressured upwards, despite all the efforts for the bank, PBOC and the SAFE and all that. Now, this is another causality, which because Japanese currency is weakening, because the interest rates between, it is a spread between bond spread between Japan and USA. It is pushing up. That is pushing up dollar JPY weaker. So it's going to 150. What if to go to 160? So that put additional pressure on the currency. So what if all this puts pressure on the Chinese currency? What happens to others is a question that we have to. And this is another important thing. This is I think 1 month old or 1.5 month old. But this shows how the pressure on normally what happens when prices deflate like this. Then they will have to they will come with some stage either stimulus or rate cuts. So that is going to happen. So this is just a depiction of it. It didn't happen, but just now, because they did some small incentive kind of cuts. But the bigger one will come because he is kind of rebalancing the whole, the balance sheet of companies and local governments and all that. So that is all coming. So coming to the impact, the biggest impact comes from, for us, is through the exchange rate. If China is going to 7.60, what happens to the Indian currency? So this is coming to AI. This is one of the graphs that we have produced using generative AI. So normally what happens is we have to do something, we have to code, we have to get the code, we have to try here, look at GitHub and all that, get the code, see what is there, then run it, then something will come, then something won't come. Here we can generate such kind of correlation with currencies and all within a minute. So this is the use of, so normal, in another way of telling is that the use of consultants and economists is, their worth or their usage or their dependency will come down because of all these products. So we also ourselves have to step up, and this is one reason, because this was generated within minutes, and I did for all the currencies what would be the impact of the rolling correlation between. You can get some of these in Bloomberg and all, but now these are all cost effective. These are all used with one button. You can just run those. Now, this is another thing that suddenly we would have noticed, that suddenly the RER has moved to the 105 levels. So that also means that with the Chinese currency and the dependency on the high correlation between Indian currency and Chinese currency, we have the RER also at a level where there can be substantial weakening, which points out. So 3-4 months ago, we could have said it is below 100. So, nothing is going to happen. But now we have come to a point, suddenly if there is a bond index inclusion or something, that sort of doesn't come, and we have an election, we are in kind of a weakening span, and we need to push the envelope. We were looking like 85, 83, 50 as a higher side. We may have to push it higher with the reserves. Of course, it will not be very, very volatile and very kind of the movement that we saw with COVID when COVID came. That kind of movement won't happen, but still we will have to be ready for raise up for above 84 levels. Now, this is another impact that China had with Europe. So Europe inflation was spiking up all the price, because China has kind of stopped taking exports in, including countries like Germany, which has a very high trade relations with China. They have slowed down. Their inflation is coming down. core inflation is high because of labor and all of that problems, but this has really helped in a way to stabilize the European. But now the question before the ECB this week would be whether they will have to hike. The market is not pricing, but they may have to hike because the core inflation is high. But then if that hike happens, what will happen to this kind of scenario? The German IFO survey, if you look at the IFO Institute memo, it's clearly said that is all because of Chinese, lesser offtake of exports. Now, this is another impact that can probably happen, which at a higher stage. We have seen that Russia, before attacking Ukraine, they almost reduced their holdings of US treasuries. So what if China starts to reduce that? It's already reducing. If you look at where India is aligned, we can see that the Indian graph is moving up. So this is investment in US treasuries and bonds. Now the Chinese is coming down. So what if rapidly they increase this stage of, for defending their currency, they decrease this, they sell US assets. That creates a problem for US financing of their deficit. Their yields move up or higher for longer. With all this bond supply that is coming in, is not getting absorbed by foreign buyers. That increases the price. That put pressure on dollar yen. That put pressure on CNY. That put pressure on us. So all this is interlinked. So it is a kind of a Markov chain. So difficult times, although they are kind of smoothing it out, but it becomes all this sudden spike of volatility will happen. And most important thing is geopolitically, China needs to change their attitude towards neighbors, their attitudes. So this is what Keynes said, the difficulty lies not in the new ideas, but in escaping the old ones. So they always think like all their neighbors and all their, small countries are all their vassals. They are the middle kingdom. Sun, China, and all the other countries are just vassals. So that is from Confucian time. So they are going with that. Mao was a big proponent of this, but then in the later stage, he didn't know how to get out of it. Then Deng Xiaoping came, and he changed the whole thing about China, and they started liberalizing and all that. Now Xi has that moment, whether he needs to, engage with the, maybe U.S. Treasury Secretary going in, Gina Raimondo, the Trade Commerce Secretary, the climate change, John Kerry going in. So maybe they're trying to negotiate. We don't know. But these are all things that is really in the background that Xi needs to change his approach towards even India. They're unnecessary. You are fighting for a space where nobody can grow even a blade of grass. Nehru said right. But still we are fighting it, and they have taken some Indian posts. You have to retaliate, obviously. So all this happened because of what you are trying to achieve. They have marked maps of Arunachal Pradesh and all, which no, but Arunachal Pradesh people won't align with China naturally. So how long some old Buddhist monk Fahian and all have visited this place. They are all claiming the territory from Philippines to the. So this is not work. So then in the global world, a liberalized world, regime, you have to change. So that time is up for China. So students and people who want to read more about Chinese exchange rate, the mechanism, their fixing, the band, what all is the normal institutions, you can visit, you can go and buy this book, Gaining Currency. 2018 book, but it gives all the structure. Nothing much has changed. How the CFETS trading happens and all that. This gives a great and also about how the history of currencies, including the normal paper currency, started with Kulbui Khan, which is actually a Khan. It's a Khan, but he was a Chinese emperor. He started the paper currency, and all history with all the new things that has happened till 2018. It is well. And this is a new book I'm planning to read. This is also very well praised. This is by, I cannot pronounce the word name, but this is a very good book. It's come in many podcasts like Odd Lots and even Surveillance, Bloomberg Surveillance and all that. So this is one book I'm looking forward to read. So this you will find out what happened to the Belt and Road Initiative, what will happen to sovereign wealth. So this is what the input is. Maybe that will help you to understand what exactly would be the future. So that's it. I think I've put the level and base metals. Although it is not breaking down, there are some spikes down possibly happening in copper, maybe below 8,000, but it won't last because the supply of material is not there. The mining, the material, the refining, it's not there. So even if Chinese slowdown continues, unless there is a big sudden shock, like a thunder earthquake kind of thing, the metal prices would kind of base out and move up. It may take time. Like next year, it was kind of forecasted to double, but it may take time. Electrical vehicles, your grids, your windmill all require a lot of base metal, a lot of copper, aluminum, silver. So the best trade would be silver. Gold may not be, because gold silver ratio is a bit. But these things will stay, and this looks at the silver is the best trade, because even if expansion happens or China escapes from this, that helps silver. And if there is some big bolt from the blue from the Chinese economy, that also helps silver with a precious metal kind of thing, which gold will pull down because of the ratio and all. That, as an investment point of view, that is. So rupee will have to shift the border, the higher mark of the rupee bit because of this scenario that has happened. And good topic, by the way.
Excellent delivery, Matthew. Though the time has exceeded, but I have one or two questions for you. No worries, and I'm going to take participants' permission to put that across to you. But before that, let me just try and sum it up what you said. You talked about China, those slowing down, not collapsing. There are a number of disappointments, and including the last piece that you talked about. Geopolitically, they are being isolated as a nation. It has an impact. There is an impact on currency. There is an impact on commodity. Currency, you talked about currency weakness, which in turn can put pressure on rupee. So you are actually now shifting your bias from 7.37 to 7.60, which in turn probably can put pressure on rupee from current 82, 83 to maybe upwards of 84. That's impact of currency. And commodity, I think you are bullish on silver. That's one clear message for the participants. Two questions which has come up. I'll put it up to you before we close the session. First is the currency depreciation or a weakness a concerted effort by the government to boost the exports? Given that there is not much of an growth from an investment-led indicator. So anything on that? Is this really
possibly? It is not, because they are trying to fight it. So how do we define it? Because every day they are trying to fix the currency on the lower side. They could have easily, with the closing, they could have easily fixed it higher side, and there has to be demand also, no? So that export side is, and then what will happen to the inflation? Then other currencies, you put an Asian spiral over it. Indian currency weakens, Taiwanese currency, Korean currency weakens. So they may not do that, and especially with now Korea starting to do some kind of new kind of regulation for forex trading and all that. They're allowing even institutions to trade in their currency, like an NDF, like China, Hong Kong style CNH kind of thing in Korea. I think the regulation has come today morning. So they wouldn't want to, and they want to internationalize their currency. They cannot have a sudden weakness like Argentina, no? So
sure.
It doesn't look like that. It will be a slow grind kind of thing. So even if you have something, the terminology that the CFAs are using is slow grind Minsky moment. It is not a Minsky moment, sudden Lehman kind of burst up. It is a slow grind. You want like a frog in hot water. You wouldn't know when
Sure.
this thing comes. So that is what it is. It doesn't look like directly they are doing, but the regime is shifting towards the weaker side.
Will HKD peg break? Is the other question.
I don't think so. See, technically, if you look at the pressure, they will have to shift it. But the problem is, it is a currency board. So the currency board thing, unless there is big realignment, that would be one reason why China is not, shifting it. Otherwise, I don't think the currency board system will have, because they can adjust the money market situation in such a way, interest rate, such a way that the exchange rate is held on par with the dollar. It becomes difficult, but if Chinese currency moves a lot away, then see, what are we talking? We are talking about small movement from 7.30 to 7. It's not big in the currency space, but Chinese currency moved from 8.50 to 6.25, 6.10, then moved back again and came down again. The Hong Kong the parity never broke, and Hong Kong had a lot of internal problems and all. It didn't break. So currency board system, I don't think it is a break. It's not a birthday. It may be a better trade would be to look at some Middle East currencies to break the peg and be,
and you foresee that to happen?
That could happen if, it is an oil dependent, there could be some kind of escalation with Israel. As of now, all those things, all those geopolitical risks around Middle East is calm, because Mohammed bin Salman, whatever he is, he's eccentric kind of, but he is, the relation with Israel, diplomatic people are visiting them. Iran now, there is a swap of prisoners, and their unfrozen account that US had with some Omanis bank, that is happening today. So they are swapping prisoners, US and Iran. That could, in fact, bring some relief in the oil markets. it's starting to move up. So that is another danger. So
excellent. I think it has been a very, very great interacting with you, Matthew. Saugata has just moved on. He had something else to catch up. So thank him and thank Matthew and thank you everyone for your patient listening, participation till this very moment. And I'm extremely sorry for extending it by 10 minutes, but it was very interesting. I could not have stopped it at 6. Thank you all once again. Looking forward to the next episode. We'll announce the date. Most likely it will be either first or the second Tuesday. First of the second week, Tuesday. but we will announce the date 2 weeks prior. So thank you all. Looking forward to see you at the next event as well. Happy evening.
bye.
Bye.